Welcome to our webinar today on digitalization and risk management, the new imperatives for BFSI. So this webinar is conducted today by Smart Online Course and the Risk Management Association of India. And I'm very delighted to see everyone here and all of our turnouts of professionals and learners who have a share common passion of staying ahead of change in this rapidly transforming digital and financial world. So, I'll just give a brief introduction about Smart Online Course and Risk Management Association of India and what we're here to do today, and then we'll move on to our session conducted by Mr. Sanjoy Kumar. So, starting with the Smart Online Course, we believe that knowledge should both be accessible and actionable. So, we are a leading India based e learning and customized training platform developed by the Risk Management Association of India. And our mission here is very simple yet powerful to empower every professional to be future ready through e learning, which is self paced, so you can learn anytime and anywhere. So, we offer a range of industry relevant courses across risk management, insurance, BFSI leadership, and professional development. And recently, our courses have also been accredited by the BFSI Sector Skill Council of India, which is a body under the NSDC and the Government of India, Ministry of Skill Development and Entrepreneurship. So, our vision here is to really transform the lives through innovative learning and to ensure that we empower every professional to be future ready, as I said. So, just giving a introduction about our founder as well, who is the director of Smart Online Course and the Secretary General of Risk Management Association of India. So, he is the editor of the Insurance Times, which is India's first monthly journal on insurance and also for banking finance. And he has authored various books and guides for various insurance exams and developed more than 60 globally relevant online courses and training programs. So we also have a lot of partner associates, so which include Insurance Times, Banking Finance, Sashi Publications, which has various types of exam books on insurance in India. Then we have Bima Bazaar and Avis Consultants as well, which provides risk management consultancy. So, according to all of these associates, we provide comprehensive training solutions related to many different fields in the risk management and BFSI sector. And we've also started covering a bit on soft skills and management development programs, which helps professionals be well rounded and develop in their careers. So, these are the main domains that we focus on. So, we have insurance, then risk management, and even mock tests. So, just for this webinar special, we've started to offer a 10% discount on all of our courses. So, I'll just take you through some of our major courses that are there, which are loved by industry professionals. So, starting with the shorter modules, so we have the quick learning BFSI modules with online courses from climate risk and business resilience, and then some related to the frameworks. So we have COSO ERM and then ISO 31000. And moving on to the bit more larger courses. So these are ranging from 5 hours to 10 hours. And these are boardroom risk governance, enterprise risk management, which are very crucial for today's risk environment and also building a risk culture in your organization. And also relating to insurance, we have certain courses like artificial intelligence in insurance and insurance underwriting, which really gives an insight view into how you need to be future ready in this field of insurance and risk management. So, moving on to the expert masterclasses, this really gives an overview into all of the main concepts that are there, but really in depth. So, these are above 10 to 30 hours, and they range from AI and emerging technologies in banking, credit risk management, and again for insurance, we have reinsurance management. And one of our major courses, of course, this is International Online Certificate course by Risk Management. Then we have the course structure here. So all of our modules are designed by industry professionals, and then we have module-wise assessments for which we also take the final exams, which is certified by the BFSI Council. So we believe in making sure that all the courses that are being done are also backed by the modules and the mock tests, which also have the case studies from the real world companies, so that you also get to know the implementation side of it and not just the theoretical and concepts of it. And here are some of the past training sessions that we've conducted. This one was in Bangladesh, this was in Bhutan, then we have another one. So, some of our clients here, I like to talk about how we've demonstrated excellence by providing them with our training sessions. So, we have done this for many across Tanzania, India, with Yes Bank, the National Life Insurance Company, Nepal Reinsurance, etc. So, I think I'd like to hand this over to Dr. Rakesh to continue and give a brief introduction about Dr. Sanjay Kumar.
Yeah, thanks, Yuki, for the overview. So before handing over the session to Dr. Sanjay Kumar, I'll just give a brief about him, Dr. Sanjay. So Dr. Sanjay Kumar is a distinguished academic and industry expert in the field of ERM, and with over 30 years of experience in Indian insurance sector. His core specializations include actuarial science, financial and operational risk management, and corporate governance. Throughout his career, he has led risk management functions in multiple insurance companies, including establishing dedicated financial risk verticals. Dr. Kumar completed his PhD on ERM implementation challenges and their impact on firm performance in Indian insurance sector. He has been a prolific researcher with over 100 published articles in national and international journals. Dr. Kumar is a certified fellow of Institute of Risk Management, London, and holds a postgraduate diploma in actuarial management from City University, London, and a senior management program from IIM Calcutta. So I would request Dr. Sanjay Kumar to take over the session and take it forward.
Yeah, thanks, thanks, Dr. Rakesh, and welcome everybody. Taking your time out on Saturday evening, uh, sparing 2 hours, right? Thanks a lot. So this session is about digitalization and risk management. Uh, Before that, let me do one check that my voice is audible and the screen is visible. So please confirm, Dr. Rakesh or Yukti.
Yeah, we can hear you.
Okay, okay, thank you. So what we are going to cover is that given the I will show a few data, but before that, what we shall do, we'll look at some of the global risk events since 2000, that and how the choppy water have been over last 25 years. Uh, Looking at some of the top reasons of the failures, uh, among these risk event which has crystallized, the importance of the corporate governance. Then that it's a glue which basically integrate the risk management is enterprise risk management. Looking at the three key elements which is essential within the enterprise risk management framework is risk appetite, three lines of defense, and risk culture. They play a very important and inherent role in developing any organization into a good risk management capability. Then we'll look at the digitization side of it, and we'll again look at that how does the digitalization is helping in the risk management process, and various elements of the enterprise risk management, corporate governance, risk appetite, risk culture, that how it has over last 4 or 5 years it has come and helped helping the various industries in sorting out their their risks and yeah, so that's what the agenda is. So first thing first, just a minute, why this is not going up? Yeah, now it has gone up. So it has been with me for I was thinking of last couple of months that let's look at some of the global events which has happened over last 25 years. And then I dig into the Google and find it out, that what have been the various risk events which has crystallized. I also wanted to write on the right hand side the amount of losses. I did it, for a couple of them, but since I could not do for all, I am not sharing those information. If you look at that, every around 10 years time, there have been around 10 events occurring, starting from the dot-com bubble, 9/11, Enron, Enron uh, debacle, SARS outbreak, right? And then if we go forward, then it is the Ebola outbreak, Brexit referendum, Amazon rainforest fire. Then when we come in the 2010, it is COVID-19, and then the Russia-Ukraine war, global inflation followed by that, and there have been various activities which has been happening around the world. So it can be seen that last 25 years have been very choppy, uh, very not very uncertain, in terms of it is not a smooth ride for the world, and challenges have been coming. And in such the challenging time, uh, the risk is to be managed. And I have wrote down an article on this also, that despite having these challenges throughout last 25 years, risk management is still taking the back seat. It is not among the prominence of the corporate. It starts from the board, then goes down to uh, senior management and then the employees. But board is the driver, and before the board, it is the shareholders and then the regulator. So these are the key people who who take a decision to have risk management getting implemented. In the Indian market. Uh, Financial authorities like RBI, SEBI, and IRDA, they have enhanced risk management capabilities in the Indian market quite a lot. But uh, within the organizations, it has yet to take the full shape into it, to make it to have a good inroads into that. And that's where I think the need of enterprise, or need of risk management is. And that's what touching few things today, to see that what are the areas that need to be looked at. uh, So some of the reasons of the failures, if we look, and if you read any of those failures which you saw in the previous slide, you will find at least one or two of these failures there, definitely. The governance, the poor culture, excessive risk taking, lack of risk management implementation, lack of risk identification, herd mentality, mindset issues, lack of transparency, failure to spot long term risk, lack of risk based decision making, improper oversight. So, these are basically the recipe. If you take it, or if any organization take it, some or other form of risk management failure is bound to come, because these are the recipe of disaster. And organization need try to improve in these areas, especially when we talk of the herd mentality. This is very much applicable in the boardroom. When the chairman takes the decision, nobody speaks. So that's the where I have given example in couple of other forums also, that in ECB, what happens that the people from regulator, they sit in the board meetings, and they want to see that whether only the voice of the chairman is heard, or there are other people also who raise the questions. So I think such kind of things are required, where the people within the boardroom or within the risk management committee are able to speak up and ask the questions about the risk and other things. So these are some of the things which is very important from the failure point of view. If we look at the corporate governance, some of the elements which is required to have within the corporate governance, like accountability of the board, and that's where, because well, shareholders have basically brought them, and it is the responsibility. They are basically sitting on the driver's seat, and everything rest on them. So accountability is very important. Transparency, clear and timely disclosure build trust. How the information within the organization, across the organization and outside the organization is shared. Fairness, equitable treatment to all stakeholders. Instead of shareholders, it should be stakeholders. Responsibility, ethical conduct, and the compliance with law. That's again the responsibility of the board. Risk oversight, long-term value creation, balancing performance and sustainability. We shall look at couple of case studies where we shall see that the failures of again some of these things have resulted into the debacle, both within India and outside. Let's look at this the comparison of these two case studies. Enron versus Infosys. In Enron, collapsed in 2001 due to fraudulent accounting, lack of board oversight, and conflict of interest, and $74 billion in the shareholder value were just vanished. It just it has gone out of into thin air, destroying showing that how the weak governance can devastate the company. On the other hand, Infosys, which is a globally recognized strong corporate governance, transparent independent board oversight company, has got a reputation, consistently boost investor confidence and a long-term growth. Let's look at what happened in case of a Wells Fargo 2016 uh, 2016 scandal. So Wells Fargo employees created 3.5 million fake account without customers' consent to meet aggressive sales target. I was reading Baiju's story few days back, and it was a similar thing there, that the salespeople within Baiju's in during their the last during the last days were so much pressurized to sell the tablet to people that at times they have to pay, the salespeople have to pay from their own pocket. So whenever such forced selling happens, it means that some debacle is going to happen. Uh, Here, so 3.5 million fake accounts created without customer consent to meet the aggressive sales target. uh, Governance failure, the board failed to challenge unrealistic incentive system, because whenever there is a high sales target, it need to be seen that whether it is achievable or not. In certain organization, uh, whenever such business plans are created, it is the role of the risk team to basically review the business plan and raise the challenge. And those challenges are documented um, within the deck, and that deck goes to the board along with the uh, business plan, and the questions are asked, that what are the questions that risk team is asking. So if that kind of mechanism is there, that risk team are being allowed, and risk team are independent enough to ask questions about the aggressive targets. It is not just the one case of Well Fargo. I'm sure that there must be many such cases happening around the world where there's an aggressive target, but that need to be asked whether it is achievable, or it is uh, some failure, or some corporate governance failure, or something that is going to happen. The impact is, the bank paid over 3 billion in fines. Its reputation was damaged, and the value dropped by 30 billion within a month's time. So the lesson is that corporate governance is not just about the compliance. It is about ensuring that board actively monitor culture, ethics, and business practices. So I would say that it is not just the role of the board; it is also the role of the risk management committee as well as the risk team, because such things get forwarded from the bottom, where risk team raise the challenge, and then then it goes to the board. Let's look at the another case study, which is Jet Airways in India, 2019 collapse. At one time, this was one of the first choice of the people, Jet Airways, and once India's largest private airline. It suspended its operation in 2019, defaulting over loan over 8,500 crore. So here again, poor financial oversight, unsustainable debt fuel expansion, lack of transparency in reporting losses, and the cash flow problem. Weak board independence. Critical decisions were concentrated with the founder Naresh Goyal. It was a centralized, team. All the powers, many of the powers were, with the Naresh Goyal, here, and in such cases, it becomes very difficult to challenge. Uh, I think the similar case was there in case of a Yes Bank as well. Failure to adapt to the changing market condition and competition from the low cost carriers, and the impact, that thousands of employees lost their job, lender faced huge losses, and the investor lost confidence. Again, the lesson is that corporate governance is not just about compliance, but about the prudent financial management, independent oversight, and timely strategic action. Uh, so the idea of highlighting these cases is that uh, these debacles have happened, and debacles will happen. The idea is to learn from such things. Now let's look at some of the benefits, because when we have talked about uh, what are the debacles which happens because of the failure of the corporate governance or other reasons which we saw in our initial slides, what are the benefits when we manage those areas, those risks? It protect the organization value, help safeguard assets, reputation, stakeholder trust against unexpected losses. Uh, Definitely, it helps in the decision making, understanding risk. Lenders can make more informed decision. So when risk management is strong, even the stock price improves. Uh, Enable resilience, prepare organization to absorb shocks, recover quickly from the disruptions like market volatility, cyber threat, or global crisis. But if it is not there, then there could be a possibility that if the company is down, they may be out. Support compliance and governance, ensure alignment with law and regulation, align with strategy, integrate thinking into the business planning, and show the opportunity, enhance stakeholders' confidence, and turn certainty into advantage. Apart from these benefits which are listed, there are many other benefits, like it enhances the firm value, uh, and we see in the next slide, this slide, that how does the values are getting enhanced among the different organizations around the world. Companies with a strong risk management practice deliver higher shareholder value. I think this is correct, and in our research also, we have proven within the Indian market that expense ratio get improved when the risk management practices are implemented. So here, the McKinsey study found that firms with a mature risk management framework were 20% less volatile in earning and delivered 20% higher total shareholder returns. These research are performed by taking the actual data and applying the various statistical tests. The operation risk reduction saves billion. In 2008 financial crisis, 15 trillion in the global market, the value were vanished. An institution with a robust ERM system avoided worse losses and recovered faster. ERM adoption, boost valuation. Uh, a North Carolina State University showed that firm implementing ERM saw an average 20% premium on the firm valuation. I think there have been, many academic research papers are there, which has proven that implementation of enterprise risk management, both in the insurance sector and the banking sector, have enhanced the firm value. And when we talk of firm value, it means into the various things. It could be return on stock, it can be return on equity, it could be valuation, right? So I think it has been well proven now that there is no dispute that implementation of risk management enhances firm value. And I think this message should go to the shareholders. Risk even destroy massive value when unmanaged. I think there have been so many cases that we have seen. Uh, Insurance and hedging shows the clear ROI. Companies effectively hedge currency and commodity risk to see up to 10 to 15% savings in the opening cash flow volatility. Cyber risk management pays off. IBM 23 report found that on an average the cost of data breach is 4.5 million. Firm with the proactive incident response plan reduce cost up to 1.5 million per breach. And regulatory fines avoided is equal to direct saving. That's the the indirect way of saying that how the value is saved. Global Bank paid over 400 billion fines since 2008 for compliance failure. Strong risk and compliance program directly prevent such massive outflows. So we can see that there is a hard cash involved when risk management is implemented and risk management is not implemented. um, I think that was the purpose of the session, is to highlight and bring it again onto the point to the table that it is important and should be implemented. I think questions are coming. I will take up the question in the end. Else it will. I think you keep on posting the questions. I will keep enough time in the end to answer the question. We saw that till this time that what are the challenges around the globe in last 25 years? What have been the key reasons of the failures? What have been the hard numbers in terms of the fines and the people can save? Let's look at some of the tools and techniques which are useful for the organization to implement, and so that when they implement they get the benefit of this the risk management. Let's look at first the enterprise risk management. So enterprise risk management, before we talk of the enterprise risk management, let's the starting point is basically the silo risk management, because without talking the silo risk management, there will be it will be incomplete to talk of the enterprise risk management. So silo risk management is the earlier version of the risk management. where risk management used to be performed by in isolation by few departments. It could be underwriting, investment, credit risk, liquidity risk. So it was partitioned, and risks are addressed individually. So what are the challenges? uh, the challenges is that many of the risks are correlated. There is a correlation within the risk. Credit and liquidity risks are correlated, and if you are managing it separately, there is a chance that if you handle one, the another one get out of the hand. So there is a need of addressing the entire risk together. And if you don't address the entire risk together, you don't get the benefit of the diversification. And further, if you are doing individual risk management, then it is expensive in nature. So lack overall risk at the company level. So I think why I was talking about failures after 2000, because 2000 is a period when the enterprise risk management has started kicking in um, across the globe. Various countries, various organizations started introducing the enterprise risk management, and silo risk management have been the it is about the matter of the past now. I think it is not being used anymore. But despite having the implementation of enterprise risk management, there have been failures, because of not because enterprise risk management does not have that ability to handle. It is because it has not been implemented properly. So let's look at what is the enterprise risk management. So we all know what is risk management process. It has got five elements: risk identification, risk measurement, risk management, risk monitoring, risk reporting. And then there is an architecture that the role of the board, the risk management policies and processes, the governance, the culture, the strategy, the three line of defense, and the integration. So when all these things are the mixed together, it basically form an integrated approach across the organization. And enterprise risk management should be implemented from the board level to the intern. The intern is the last employee within the organization, will just come in for a month or so, and that person also should able to get the idea about what the risk management within the organization is. And it should be integration, that everyone is doing the risk management. Then it comes the concept of three lines of defense. Then only it will happen. First line means all employee, second line means risk team, risk and compliance, and then the audit team. So it need to be integration. uh, and it should be part of the daily working culture. It is not that the credit risk or the risk is done once in a quarter. That's not the way the ERM works. It's like the entire body is linked to the veins, and it's just like our body. It works. Everything is connected through, and our blood is flowing. And if any part of the vein is cut, I think it will be a recipe for disaster. And this is what happens in many of the organizations when the entire thing, when entire system, is has got the challenges built in or created. Then the ERM does not work properly. It's an orchestra which work together. And if anything goes out of the sync, the music will not be well to the ear. So how ERM is different, and where to focus. One, as I said, that it's a new concept, started after 2000. Integration across the organization. Risks are correlated. Risk appetite is something which need to be created either across the organization or the individual risk wise. It helps in capital optimization. most of the financial institutions like banks and insurance companies, they have to keep capital, and capital is a shareholder's money, and that's where shareholders are interested to minimize the capital injection and optimize the return on capital. Uh, Enterprise risk management help in optimizing the capital. Um, Three line of defense and the culture basically comes is under the how does it helps working well? How does three line of defense and risk culture enable organization adopt risk management and function it like like an orchestra. And what are the differences between the two types of risk management? Because one can identify that within an organization, whether it is in silo risk management or an enterprise risk management. In silo, if the focus is about it is department level, in ERM it is organization level. Approach wise, in silo it is reactive and fragmented. In ERM it is proactive and integrated. Visibility point of view, it is in silo it is narrow functional view. In ERM it is holistic and enterprise wide. Decision making, in many of these silo risk management, it is very short term and sometimes even is not used. ERM is strategic, integrated, efficiency, duplication, blind spot, streamline, and accountability. Here the individual managers are accountable. Here, the shared leadership responsibility, because uh, all the CXOs are the owners of the some of the risks, or basically all the risks are being divided among the CXOs, who become the owners of the risk, and the board is the basically, so there is a responsibility among the CXOs in terms of the owner of the risk. So responsibility get fixed. Let's look at the risk appetite. And here, I'm going to share my personal example. And um, he- as a child, as in our days, there used to be no television, no internet, nothing. What we used to do, is to fly the kite, play the marbles, and I was quite good at playing the marbles. So I I had a very simple formula of every evening I used to go and play marbles, and my formula was that I used to take only 6 marbles with me, and my rule was that I will not come back to take any more marbles again. So on any particular day, and my logic was that if I lose in any particular day, my maximum loss will be 6 marbles. That was my maximum loss in any particular day. So through this, I collected basically the thousands of marbles, because my winning rate was very high, and my losing was what any particular day was a 6 marble. So at that time, I was only limiting my loss, and I had no idea. And today I understand that I was doing the risk management, and these are the concept that I was limiting my loss to 6 marbles maximum. And now the question is, this 6 marbles, which was, my risk appetite during my playing days as a child. It could be any company's the $6 million for any particular day. Any particular day, if any organization say that my risk appetite of a loss for any particular day is a $6 million, that becomes his risk appetite. So if anybody, any organization, or $7 million has got, so that's the concept of the risk appetite. And this also has got the concept of the value at risk. Value at risk work at the same concept, which is used in the modern risk-based capital. Risk-based capital is worked on the concept of value at risk, where it identify that how much money you should have within a year, that you should keep it, that you stay afloat, that how many marbles you should keep it, within in your box, so that you keep on playing for the entire year. That was the concept. If I convert the example of marble into the today's the example of the risk based capital, is that's the parallel that can be drawn. So what is risk appetite? It is defined as the amount of the risk that organization is willing to accept. uh, it is it can be defined either quantitatively or qualitatively. Risk appetite is less meaningful in isolation. uh, and it is another example that can be taken, that if you're driving a car, or like, and how much gas it has got it. So amount of the gas that it has got it, or the petrol it has got it, to reach to up to the destination, that's what the maximum you've got. So here your gas is like your risk appetite, and reaching the destination is become the organization's objective. Because within the risk management concept, if the organization's objective is not brought into the concept, then the risk management is meaningless. It does not exist. Without the objective, it does not exist. So there could be many parallels that can be drawn to understand the concept of risk appetite. So that's what the about risk appetite. To understand it, let's look at some of the case studies from the practical point of view. Um, Yes Bank, 2020. Yes Bank, once it is still it is still existing, but went into crisis in 2020 due to excessive exposure of high risk borrowers. The bank had excessive aggressive lending to companies, infrastructure firm, and the stressed corporate without adequate assessment. So where was the risk appetite failed? No clear boundaries. The bank did not set or enforce clear limit on lending to the weak customers or the stressed customer, because it is not always that you put a hard limit. It is not always the $6 million or the six marbles you have to keep. You also have to identify, like with whom you play, with whom you are lending it. That's is also the qualitative risk appetite. Aggressive growth. So if you're keeping aggressive growth more than the discipline, this, as I said in one of the previous example of Well Fargo and Byju's, it become the challenge. Leadership prioritize loan book expansion and the profit over the prudent risk taking. Concentration of risk. A significant portion of loan went to a few risky sectors, far exceeding what the conservative risk appetite framework would allow, and ignored the red flag. Rising NPA, non-performing asset, were overlooked, and lending continued despite early sign of distress. So at many places, risk appetite were not drawn. It has breached many of the fundamentals of the risk management, and we see that the debacle happened. It's though risk. Yes Bank is still in operation as yeah. So what was the impact? The bank faced the mounting bad loans of 40,000 crore, leading to erosion of depositors' confidence. RBI had stepped in with the moratorium and restructure plan, and SBI and other banks had to bail out Yes Bank. Shareholder lost value, and the bank's reputation was severely damaged. These are the outcomes. Reputation always get damaged. Uh, yes Bank's downfall highlight what happens when the organization lacked discipline, risk appetite. If a bank had set the clear boundaries on credit exposure and enforced a conservative appetite for the risk lending, the crisis would have been avoided. I think it is a quite sensible lesson in terms of what happened. Let's look at the three lines of defense, because these are the fundamentals of the risk management. which keeps the enterprise risk management running. This is the three lines. First line is all the employees except risk and compliance, and it is their roles and responsibility to do the risk management. Um, the role of risk management team is to review and challenge. They become the custodian of risk management policies, and third line is the audit team. And proper functioning of three line is essential for embedding ERM. I think when it breaks, and one of the challenges that we shall discuss in the next slide is that this model is not properly working in many organizations. I think that slide, seems that okay. Because what happens that the first line is not trained in the risk management, and as a result of that, most of the work is being done by the second line. As far as my experience goes, I have seen that happening, and that is not ERM. It is some form of half-baked silo risk management, half-baked enterprise risk management. I think this is the same example, which is coming. Okay, let's look at the risk culture. Risk culture, again, one of the very important ingredients uh, which help develop employees into a proactive risk managers. And it starts the fundamentals of the risk culture starts with the the personal disposition, like what individual thinks about the risk, then the what is the personal ethics, behavior, organization culture, and then the risk culture. So um, that's how in general how does the risk culture comes out. And it is there that the organization comes and help, because every individual is coming with a different perception about the risk. They may not be all at the same place, and they need to be brought together about what the organization risk ethics are, so that everybody acts in a sync. And that's the role of the organization is, and that's become the difference between a good organization with the risk management and a not so good organization with the risk management. This is a very important slide in terms of risk culture, and I will show you why it is so. It is an IRM model, Institute of Risk Management, London. They have identified, this is identified that there are the four buckets torn from the top. Governance, decision making, and competency are the buckets essentially required to develop a risk culture. And within each bucket, torn from the top, is that the risk leadership should be there, and dealing with the bad news. So when you say risk leadership means that the CEOs and other people should constantly encouraging the employees to take the risk management activities. How does the top leadership deal with the bad news? Generally, bad news are hidden. That's the culture within most of the organization. But the organization which are good and their culture, risk culture is strong, they share the bad news with the employees. So that's what IRM recommend, that even if there is a bad news, that should be shared with the employee. I think we have seen even in the previous slides that accountability and transparency are one of the fundamental elements of the governance. And these two elements, should be there within the risk culture, and it should be adhered by everybody. When it comes to decision making, informed risk decision, that whenever the decision is taken, it should not be taken without the inclusion of risk management. For every decision, identify what are the risks, and the reward, the reward should be there. There should be some element of reward within the organization at all level of that how does the employees are rewarded in terms of how the risk management is going within the organization. And when it comes to competency, this is where the people comes, and that's where the first line of defense and the second line of defense is the risk resources. uh, what are the risk resources within the organization? Are they hiring right people? Whether people are adequately trained? Risk skills, whether the risk trainings are going on properly within the organization. And we'll see in the next slide that various regulators around the world have following many of these elements. So this I've taken it from one of my article, and I have taken it, this is the same table where the four buckets torn from the top: governance, decision making, competency, and again within that. Now, what I want to show over here is that these are the regulators like ECB, FCA, APRA. APRA is the Australian regulator. It's the Netherlands regulator. This is the Australian regulator. This is the New York Fed. And if you can see here, that these elements are most of these elements like tone from the top. Incentive is coming from the reward. Accountability is coming from here. Ownership will again come from governance. Constructive challenge is one of the important element of the risk culture. Communication without fear, this is, I would draw some parallel with dealing with the bad news. Risk capability is comes from risk resource and skills. Risk-based decision making, again coming from your informed risk decision. And oversight is basically is quite that it should be done. So you can see that most of these elements are being adopted by most of these regulator. And the cross is that which regulator has got these elements, they are recommending to their country that they should do it. And you can see that um, across many of these regulators, there is the cross there. It's somewhere, some places there are NA not applicable. So that's the importance that globally this metrics is being I will not say this metrics is adopted. I will just say that these are the good things which IRM has documented it, I think, long back. And such good things are to be adopted to develop the risk culture within the organization. This is again similar same case study of Well Fargo case, where it can be looked at toxic incentives. Senior management created a culture that prioritized short-term sales over ethics and compliance. Fear of speaking up. I think again, there is a lot of importance on sharing the information, whether it is a good news or a bad news. Fear of speaking. Employee who raised concern were ignored or retaliated against, discouraging the whistleblowing. Uh, Board oversight gap and normalization of misconduct. Unethical practices become routine, accepted as how business is done. So you see that when risk culture it get compromised, the organization's value get compromised. It's the same loss, because loss will not change according to the why it has happened. The This is another example, an Indian example. uh, Punjab National Bank fraud 2018, which is one of the largest India's public sector bank. Fraud of 13,000 crore involving jeweler Nirav Modi. Here again, it was weak internal control. Uh, collusion of employees, staff at the branch level ignored procedures, management blind spot, senior management failed to question unusual high traction, and over reliance on the few customers, right? So this again indicate that failure of risk culture bring the downfall, or bring the bring the loss to the entity. uh, in this case, the impact was more than 13,000 crore, made it one of the biggest banking fraud in the Indian history. PNB stock crashed, and this scandal shook the confidence in the Indian public sector. Risk culture failure is not just about weak systems. It is about people normalizing shortcuts, ignoring red flags, prioritizing convenience over compliance. So I think those were the generic risk management requirement to be successful within an organization. And now we shall look at the digitalization side. That how does the digitalization? I think questions are coming. I'm happy that it is coming. I will take up in the end. You keep on posting it. Digitalization is basically uh, how digitalization is helping risk management processes and various elements like culture, appetite, three lines of defense, risk management process. Because um traditionally it is very human dependent, uh, very process dependent activity, and but when it get the inclusion of uh, technology, it fasten it up, and the speed and the accuracy brings a lot of value to the organization. So BFSI, sector evolving risk of cyber threat, fraud, compliance. I think we all know it. As we said, the traditional risk management is manual and reactive. Reactive, depend whether it is silo or it is enterprise. Digitalization is proactive, data-driven, agile. Uh, these are some of the attributes of the digitalization inclusion. Some of the building blocks of digital technology, which is causing the disruption, is basically the big data, the data integration, Internet of Things, and AI ML. Uh, Big data is, basically your data lakes are installed that collect the data in the original format. So data is collected in original format, whether it is structured data or it is an unstructured data. It is collected. All data is collected together. Data integration, taking the data in the original format and converting it into the standard format. So basically converting the data which has come. Some of the data could be unstructured, that need to be converted into the usable format. So that is the another activity which is being used. Internet of Things. Internet of Things, the internet connected objects that collect transfer data wireless on real time. This has been used quite a lot in the car insurance, health insurance specifically, where the data can is transmitted directly from the customer to the insurer, whether it is the health insurer or it is the general insurer, and information is almost on a real time basis. So it helps a lot in terms of risk identification, uh, claim processing, and many other things. AI ML, it is this human simulation, intelligent machine. It thinks the way we think like a human. So integration of all these things is helping financial institutions expediting the risk management activity and helping it up. And we shall see that what are the how it is helping it out. So it is helping, in risk. I will just skip this slide. We'll get into, Let's look at that how it is digitalization helping in risk identification. We'll look at each element of the risk management process, that where digitalization is helping, and what are the changes are happening. So it allows the firm to scan the massive structured and unstructured data to uncover the emerging trend, market signals, customer behavior, social media trend, transaction anomalies can be flagged. And when all these data are collected together, banks, use big data to detect early credit stress among the borrowers. So those, people who are borrowing the loan, um, it become possible to basically see that, what are their credit history, what are their, the spending pattern, and whether to give, loan to them or not. So the risk identification, because one of the challenges in the banking side is the credit risk is one of the big risk, to knowing that the credit worthiness. So here, these big data analytics helps in risk identification, artificial intelligence and machine learning. So AI model recognize patterns that human may overlook, spotting new risk categories. One of the challenges in the risk management process is that if we fail this step, then the subsequent step will not happen. So that's where the AI model recognize pattern, and they can spot the risk. Uh, for example, the behavior, whether the particular behavior is leading to certain things, and if it is so, then it can be identified much in advance rather than later on when the event is about to crystallize. So especially this is useful in the fraud detection system. Use ML to identify uh, unusual spending behavior. This can also be done in the those customers in the insurance sector who lapse the policy. So based on the behavior, that what are their behavior, it can be identified the likelihood of lapsing the policy. Automation and digital workflow. So manufacturing plants automatically log safety incidents via the digital platform. So this is how risk identification is helping. IoT sensors and technologies. Smart sensor track physical environment like temperature, vibration, pressure to flag safety operations. And supply chain risk can be identified. External data and digital sources. Energy firm track climate data to assess flood and drought risk. So it can be seen that these technologies are helping in risk identification. I have kept one more slide in the to for the financial industry, that how digitalization is helping in risk identification. So banks use AI-based credit scoring tool to go beyond the traditional credit bureau data to evaluate SME borrowers. Uh, Investment banks deploy real-time risk engine to track value at risk across portfolio. Payment gateways use ML algorithm to flag suspicious transaction instantly and stop fraud. Bank use real-time AI to detect unusual login behavior, preventing account takeover. Uh, Indian NBFC use RegTech to stay compliant with the RBI's dynamic regulation. So it can be seen that these technologies have already get into the system and helping the organization. Now let's look at that how it is helping in the quantification. I think quantification again is quite similar, because once the data is there, it becomes much easier to quantify, uh, which was earlier difficult. Big data and AI model, uh, millions of transactions detected, and probabilities of fraud and other defaults can be identified. Monte Carlo simulation, IoT, Internet of Things, and real-time data feeds. I think this has become very, very useful among wherever the transfer of data is. Uh, Predictive analytics, forecast credit losses, uh, and if you look at some of the examples in terms of the quantification. So AI and big data process, borrower repayment histories, transaction, GST filing, digital footprint, calculate probability of default. So it has become much easier to calculate the likely, default is. Market risk quantification. This is the same example. So ALML model, measure the fraud likelihood by analyzing millions of transactions per second. Cybersecurity regulatory compliance. Let's look at some of the mitigations, that how digitalization is helping to mitigate the risk. Uh, so AI and ML models continuously monitor borrowers' behavior. So when it is continuously monitoring the borrower's behavior, it becomes easy to again identify the likelihood of the default, and the loan can be either may not be given to them. Early warning signal, flag stressed account, so bank can restructure loan. Digital collateral management update valuation. So Indian bank use AI based credit monitoring to detect early stress in the uh, corporate borrowers. Health insurance is using wearable devices to offer discounts on the health style habits. Similarly, among the car drivers, helping identify that how they drive, and based on that their premiums are adjusted. uh, Claim risk mitigation. Insurer use AI to scan photos of the car accident. So earlier, what used to happen, that once the accident happened and the survey happens and then it is paid. Now the photos are scanned and the claims are processed immediately. Uh, Global investment bank run value at risk. Life insurer use AI to flag fake death claims. I think this is very important from the insurance company's point of view, that the fake death claims or fraud within the insurance sector is quite prevalent, and AI models are being used so that they can identify that what could be the possible fraud could be. Onto the monitoring side, if we look at uh, global banks use the real-time dashboard to monitor the various it is not just the credit risk exposure, but all the dashboard you can see. IoT sensor and based monitoring, you can get all the data. E-commerce platform use AI flag unusual transaction and prevent fraud. So, cybersecurity system auto alert IT teams when unusual network activity detected. And when it comes to reporting, uh, banks use real time dashboard for reporting purpose. They use dynamic risk heat maps instead of uh, the hard copy of the reports. uh, Multinational firm consolidate risk data from various countries. It has become easier to consolidate the information from the different countries and present the report. Regulatory and stakeholder reporting. It has become again easier to file to the regulator. So you can see that the risk management process within the it has become enhanced because of the digitalization. Now let's look at that how it is helping the enterprise risk management. Because when we talk of enterprise risk management, it is about integration across the organization, and the digitization should help in integrating it. It creates a single source of truth by consolidating data from the multiple sources. Provide management and the board with a holistic view of the enterprise. So a global company, integrate the data from various departments and present, one report. Breaking down silos, cloud-based ERM system connect business units, enable consistent risk identification, entire process, encourage collaboration between various teams, and banks are using, or not just the banks, but most of the institutions are using the GRC tool, which combines governance, risk, and compliance. Embedding risk in decision making, digitalized tool, link risk matrices directly with the business KPI. Real-time monitoring and predictive insights. That's how enterprise risk management. Consistent culture and accountability. Digital ERM platform assigns risk owners, track responsibility, and escalate issues automatically. This ensures accountability is clear across the organization. Let's look at how does it is helping in corporate governance. Some of the attributes of the corporate governance is the transparency, disclosure, board oversight, compliance, and accountability, and how the digitization is helping. That tools enable real-time financial and non-financial reporting to the board, which become more transparent. Digital visualization makes governance reporting clear and accessible. How it strengthen the board oversight. Digital board portals provide directors with secure on-demand access to the report policies. AI driven insights help board evaluate emerging risks and the opportunities effectively. uh, how it improve compliance. Automated compliance system track regulation and ensure. I think it happens through the GRC system. Workflow tool design responsible and to create audit trail. Enhance shareholder and stakeholder engagement. Digital platform allow virtual annual general meeting, online voting investors. Uh, Foster ethical and the culture ESG. Digital, digitalization track ESG metric. So it can be seen that digitalization even helping in integrating the risk management across the organization. uh, how it is getting into the risk appetite mode. uh, it connects risk appetite with the real time, so it is basically helping uh, calculate the risk appetite, dashboard compared to the actual versus expected. Scenario analysis and the stress testing. Digital tool simulate what if scenarios, and when you have got what if scenario, it gives you various scenarios, and it become easy to create the risk appetite around that. Help board to see if the current risk appetite would hold or need adjustment. Dynamic monitoring KRI. AI analytic track key risk indicator continuously to check alignment with the risk appetite. Cross organization alignment. So digital ERM system ensure that the business unit interpret risk appetite consistently, and supporting board and regulatory oversight. Digitalized reporting ensure board and regulator get clear evidence based insights and how risk appetite is set. So let's look at how it helps in risk culture. Again, we saw that there are certain attributes of the risk culture like awareness and training, transparency, communication, encourage, speak and the culture. So digital learning, platforms is coming up, within the organization to deliver the risk awareness. So instead of having the risk training once in a quarter or once in a month, many organizations are having online risk training modules, and the employees can, access to that. Transparency and communication, digital dashboards make risk visible to everyone, not just to the senior management. I think this is a very good point. Transparent reporting reinforce the idea that risk is everyone's responsibility. Encourage speak up culture, online whistleblower tool, anonymous reporting app, and the feedback platform. So this is, it helps to basically speak up and, raise the question. Cross organization alignment, digital ERM system ensure, digital business unit interpret risk appetite consistently, and supporting board and regulatory oversight. Let's help in risk. I think this is the same slide which has been copied. How it helps, in three lines of defense. So first line of defense is automated risk identification, digital tool embed ERM system to capture, risk data, um, and the dashboard for the managers, it can be created. So a logistic company use IoT sensor to flag delivery risk, which is the frontline manager to see the real-time dashboard. Integrated, GRC platform provide enterprise-wide visibility to the risk appetite. And third line of defense, continuous auditing. Automation enables auditor to test control continuously instead of once in a year. Integration, across all three lines of defense. The single source of truth, centralized risk data ensure no duplication of gap. And collaboration tool, shared platform allow all three lines to work together, while maintaining independence. So I think it is reasonably, presented that what are the basic elements. What we saw that, what has happened over last 25 years, what are the failures, reasons of the failure, what are the, important elements which helps organization develop the enterprise risk management, and how does the digitalization helps in enhancing those basic elements of the enterprise risk management to function much better. So I think that's the overall message, which is, of the session. And I would like to, now take up the, I will just go through each question, and let me just, go through it one by one. Yeah, Komal has asked one question. It's a good question. The question is that all risk events come to light only when the damage has happened, never before occurrence. What is the reason and how this can be addressed? That's the uh, hitting, hammer on the nail, and that's what we have been talking it about. That's what the risk management is. This is something is called the reactive culture. In reactive culture, what happens that the risk event or the activity, when the risk has crystallized, it come to come to know only when it has happened, because there is no mechanism within the organization to identify the risk. what we have seen today is that there are, ways to though we haven't seen, but there are ways to identify the risk in advance. So risk is always futuristic in nature. So every organization is to identify what could be the possible risks and prepare for the action. They cannot take action in advance. They have to prepare for the action before, the risk even crystallize. And if they are not doing that, then that exactly happens what you have written. This is a reactive culture in such organization, and all the events that you saw, from 2000 and even within India at many places, which you see that, the glass is broken even within your house. When you have, kept the, half filled glass of water in the edge of the table, there is a high likelihood, that it can fall, and it does fall, and that is a risk, because you have not seen, or you have not taken the action to remove the glass of, water, half filled glass of water away, and that is why it has fallen. So that's the reason. What is the reason how it can be addressed? So how it can be addressed is that there should be a proper procedure within the organization to identify the risk. There should be a department within the organization whose role and responsibility, they have to train the first line of defense, that how to identify the risk so that it does not happen. If they do not do it, it will keep on happening, and when such thing happens, it is called crisis management and not the risk management. Hope I answered your question. Another question is, Pranjit, proper periodic risk inspection and mitigation plan are essential. They help identify vulnerabilities. I think he is making a comment. That's right, to reduce the claim frequency. Afzal Bhai is saying that now he can hear.
That
Again,
problem has been resolved.
yes, it is resolved. So again, Komal is saying that business innovation and risk management has to be balanced from organization perspective. The skew is towards business since its prime contributor to the bottom line. How would risk management ever be considered uh, an ally of the business? Again, a very good question. It seems that there are challenges, So Komal, the problem is that every organization definitely works for the top line, for the business. That's where shareholders put the money. Simultaneously, shareholders don't want that, their business, go down. And that is why there is a need to do the risk management. So in order to do the risk management, the entire process is required. And as we discussed in the entire session, that it starts from the board. Somebody is to take an initiative. Whether the initiative comes from the regulator, they make it mandatory. They take certain action, um, like but or they visit the organization every quarter and identify what are the things which has not been done. Right? So there is a way that the policies are need to be created, the chief risk officer is to be appointed, the risk team is to be created, the first line of defense is to be trained, and then it will be done, right? So the balance is to be created, you are absolutely right, but it has to be done. The effort is to be made, and that is the challenge within the Indian organization, that that effort is still on the lower side. I fully agree with you that many organizations are struggling, and that is why we talked about today the entire thing, that what are the things it should be, and what are the things it does not, when it not happen, what are the losses it happens. So just a minute.
4,07,000 का ये भी आ रहा है तुम्हारा रिजर्व में अब ये
Let me
चलेगा
just go down.
3,91 3,91 तो मेरा ईयर में दिखना चाहिए
There is one question from Mr. Sharif and Mr. Nitin.
Yeah. What is the question, sir?
From Mr. Sharif, how can BFSI firms ensure inclusivity and accessibility while managing risks in digital channels?
How BFSI firm ensure inclusivity
Inclusivity.
and accessibility while managing risk and digital channel. Can you just expand this question?
Or if you are here, Mr. Sharif, you can unmute and you can speak also. It is open to all. Meanwhile, you can take next one from Mr. Nitin.
Hmm.
Market and realities are changing. Firms do take proactive action, but because of market nature, human grid, sometimes some of new risk emerge.
Market and market realities are changing. Firms do take proactive action, but because of the market nature, human create some new risk emerge.
I think
Yes,
it should
I
be
think
human
no,
grid.
I think right. It is a good sign that market and market realities are changing. Firms are taking proactive action. Uh, yes, it is happening. I think before the session, I was thinking about that what is happening in last 6 to 8 months around the world. That the market or the realities are changing, right? Uh, so the question is that mm, that it, it has to be continuously evolving, and it is a full-time job, and one need to be scan the horizon. Therefore there is a word is called the scan the horizon and continuously start looking at the newer risk, because if you start looking at since last 10 months, the water has become much more choppier, and there is a much more turbulence, and you will see that in next 6 months time the impact will start coming it. So we need to be proactive. We need to anticipate now. We are in the month of October. We have to anticipate today, in the next 6 months time, what impact is going to come, or what has happened over the last 10 months, and how we can manage that. A similar situation happened, if I am not wrong, around the COVID, that around January, I think everything was fine in the Indian market, and after March, everything got upside down. So yes, it is good to be proactive, but it need to be continuous in nature. So as we see that the last 25 years have been challenging, I think coming time will be much more challenging, and we may require the tools like who can continuously evolve the entire the various areas. If we have got an AI tool which can continuously evolve not only the economic parameters but also economic, demographic, political, it's something called PSTL. Then we can identify that where could be the risk area and where is the need of changes there. So that's what I think the reality is, and I agree with you. Uh, uh, are Ion, what strategies can be prudent risk management framework adopt to anticipate and mitigate impact of rare, high impact black swan event? Uh, yeah, that's a very good question. Say, such events, if we look at, few examples in the past of some of the black swan events type of event is like 2008 economic crisis and 2020 um, 2020 COVID. And if you take some learning from that, then it tells that we need to be prepare for Of course, for the COVID, it was not possible to anticipate what happened during the COVID. So I think Black Swan is one of the rare events, and it is very challenging to be prepared for that. Uh, and for this, it basically engulfed the entire economy, it engulfed the entire society, which it is a a challenging event.
So I think we are coming to the close of the session. So if anybody has any questions, they can unmute and ask directly, or we shall just proceed to close the session. So just recently we launched an ebook on future trends in risk management. So you can just email to us. We will share you the copy. I'm just sharing the email ID. You can send a mail in this ID. We will share you across the ebook that we have released on future trends in risk management. So I think we don't have any more questions. So thanks a lot, Dr. Sanjay, for having a very nice session elaborating the things in detail, how digitalization works in risk management and what are the future risks, how it needs to be mitigated. And I think as the technology is continuously evolving, we also need to continuously hold this sort of programs and interact regularly so that we can figure out what are the missing links, missing gaps, and we can in future we can plug those gaps and frame our strategy in the same direction. And I also like to thank all the participants for joining today, and hope this session was useful. So very soon, maybe by the end of this month, we'll again be back with a new session. So you can just keep on watching our LinkedIn or website. So we will announce our next session maybe by next 15 days, and we keep on releasing new ebooks. So for this ebook on risk management, you can just email to us. We'll share you the copy. So thank you, everyone.
Okay, thank you,
Thank you, Dr.
thank
Sanjay.
everyone, thank you.
Thank you.